the benefit of those who are not aware, the Wilson Center is the national memorial to President Woodrow Wilson, a scholar, a politician, who interaction between those who formulate, execute policy, and those who study policy. And that's what we are going to do today in this 5th Symposium on International Trade. We have been having these events every Friday of Carnival for many years. So just before we take a little bit of license of our, take leave of our faculties and dance, we talk about trade. Obviously, this has been last year when we gathered here, the very heavy clouds of protectionism were clear. They had clearly formed. Now it's pouring. We are in a very difficult era, which makes this discussion, I think, even more timely, more important. I would like to welcome a few people here that are very important to me. I'd like to start with Bill Klein. I learned a lot as a journalist from Bill Klein. He was one of the most patient people in Washington. And I have been here for almost 30 years. I really bothered him quite frequently over about 25 years. When Brazil had a debt problem, things have changed a little bit. Now we were just talking and trying to compare the situations in those times. Also, not yet here, I think Jeffrey shot, I don't see him, but another person very dear to me, my dear friend Ottaviano Canuto, Vice President for Countries at the Inter-American Development Bank. But as some of you may already know, he is moving on, going back to the World Bank, where he was the executive director for Brazil, but now is going to join the staff of the bank in a very senior position as vice president for an area that takes care of poverty reduction and economic management. So in this time of difficulty, Ottaviano will have a very challenging job, but I'm sure he's up to it, and I'm very glad to have him here at the Wilson Center. Lita Espíndola, a dear friend, senior official from the Brazilian government, who lived also in Washington. I'm very glad to have you here, Lita. Obviously, Aloysio de Lima Campos, who is our partner here, has been from the ABCE in putting together these events. And a special welcome to Minister Carlos Abreu, here representing Ambassador Patriota, that I understand is in Brazil, helping to prepare both the visits of our foreign minister, who will be in Washington next week, and President Lula, who will be here, who will come to Washington in mid-March for his meeting, a visit with President Obama. So with that, I would like to give the floor to Minister Carlos Abreu.
Well, good morning, everyone. Ladies and gentlemen, it's a pleasure to welcome you to the Wilson Center for the 5th International Trade Symposium of the ABCI Institute. Now, in its 5th year, this event has become a much anticipated annual gathering on Washington's international trade calendar, and one that the Brazilian Embassy has been proud to support and will continue to support. I would like to begin by thanking those who have made this event possible. First, our host, the Wilson Center's Brazil Institute, and its director, Paulo Sotero, our dear friend, who made available this magnificent facility and support staff. The symposium organizers, the ABCI Institute and its chairman, Aloysio de Lima Campos, who put together the program and organized the impressive series of speakers you will hear today. Also, deep appreciation to the sponsors from Brazil, Machado Meyer Advogados, and from the United States, Miller and Chevalier and Sidley Austin. I also would like to note our sincere appreciation to Arnold and Porter for its continued support. The ABCI Institute and its predecessor, the ABCI Discussion Group, will commemorate its 5th anniversary in April of 2009. Its objectives perfectly match the Brazilian government's policy of helping to provide training and international experience to a growing corps of international trade professionals in Brazil. The ABCI Institute seeks to foster the study of international trade, providing, among other things, in-depth discussions of important matters, including symposiums and seminars for individuals in government, private practice, business, and academia on various aspects of international trade, while developing an international trade bibliography and researching and circulating international trade news, articles, expert commentary and analysis, event announcements, and any other activity directly related to the study of international trade. This year's symposium focuses first on the effects of the global financial crisis on trade, and second on other challenges such as energy and environment. I'm certain that the panels of experts put together for this year's event will provide you with a complete picture of the present status and perspectives in each of these important issues. Today we also benefit from the participation of Lita Spindola, Executive Director of CAMEX, Brazil's ministerial-level interagency decision-making trade body. I hope I got it right. Who will provide an update on what Brazil is doing regarding trade facilitation. She's in Washington for meetings with her U.S. counterparts in order to discuss ways and means to foster our bilateral cooperation on the different aspects of the important issue of trade facilitation. Ladies and gentlemen, relations between Brazil and the United States have been advancing rapidly in practically all areas, and the Brazilian government now looks forward to building upon our past achievements with the new U.S. administration. With this goal in mind, Brazil's Minister of Foreign Affairs, Ambassador Celso Amorim, will be in Washington next week for a meeting with Secretary of State Hillary Clinton. As I presume you already know, President Barack Obama took the initiative to invite President Lula to come to Washington. We are still working on the precise timing, perhaps a date in mid-March. They will also meet again during the following month at the G20 Summit in London and also at the Summit of the Americas in Trinidad and Tobago. As I'm sure you will all agree, our two countries will have plenty of opportunities during a short time period to continue to foster cooperation on bilateral, regional, and global issues. It is safe to say that relations between the two largest democracies and economies of the Americas will flourish even more in the years to come. We believe it's through a dynamic exchange of information, dialogue, and mutual understanding that both Brazil and the United States can best explore common interests and move rapidly forward towards achieving mutually beneficial trade, economic, and political objectives. This is precisely the purpose behind initiatives such as this 5th International Trade Symposium of the ABCI. I wish the best to all of today's participants, and I look forward to listening to the important discussions that are about to begin. I'm glad you're here. Thank you very much.
Thank you, Carlos.
I'm sorry. You're going to pass the floor to Aloysio?
You can do it.
Aloysio, I'll pass the floor to you.
Thank you. It's an honor. Good morning to all. Welcome. I'm Luiz Lima Campos, Chairman of ABCI Institute. And I'm not going to make any speeches. I'm just here to introduce Lita Spindola. It's my distinct pleasure to do that, since not only we have participating together in meetings this past week, but also because I think it was a great opportunity for you in this environment of crisis, and which is usually a fertile ground for protectionism, to talk a little bit about what Brazil is doing in trade facilitation and sort of countering what the normal trends are in these kinds of economic situations. So it's a pleasure. Lita, please, you have the floor.
Thank you. Good morning, everybody. I would like to thank Aloysio Campos for inviting me to participate at this seminar. I would also like to thank Mr. Paulo Sotero for his permanent support of CAMEX initiatives. As mentioned by Minister Carlos Henrique, CAMEX is the Brazilian Chamber of Foreign Trade, the public office responsible for strategic decisions on trade-related issues, such as tariffs, trade remedies, and trade negotiations. CAMEX currently coordinating an important interagency effort to facilitate trade. The Brazilian Trade Facilitation Group is part of the bilateral dialogue under the initiative of the U.S. Department of Commerce and the Ministry of Development and Trade of Brazil. A working group was created and comprises 35 different agencies. This group is responsible for reviewing and updating legislation and procedures. The goal is to reduce the burden for exporters and importers while fostering compliance and enhancing security. So far, this group was able to perform a comprehensive review of licensing procedures and requirements for exports and imports. Many licenses have been eliminated, from aircraft parts to agricultural goods and medical devices. The working group was also able to reach an agreement to ratify the Istanbul Protocol Convention, ATA-CARNE, which has been sent to the Brazilian Congress last week. It will allow free movement of goods for fairs, expositions, professional, educational, scientific, and cultural purpose for athletes and travelers. But this is an ongoing process, and much work has to be done. We are aware of the challenge we are facing and how hard it is to change culture and procedures. During the last couple of days, representatives of this Brazilian group had important meetings with their counterparts in the US to exchange views on how to improve coordination between customs and other regulatory agencies. We also discussed risk assessment criteria for targeting goods for enforcement and inspections, and to reduce delays and costs to business and consumers without sacrifice compliance and security. Specifically, we are implementing better risk management tools with a view to reduce red tape and facilitate trade. We also learned about operational procedures such as pre-arrival processing and post-release checks. The importance of public-private partnership was also discussed. There are many US and Brazilian companies interested in fostering a pro-competitive environment. We found there is room for cooperation and possibly to work on MOUs to harmonize certification requirements and implement mutual recognition. ANVISA and FTA had specific side meetings as well as DEA and federal police. The Brazilian Tax and Customs Administration and CBP had the opportunity to exchange views on important issues of mutual interest. Other agencies, particularly agriculture, are also engaged in this work, and important measures to streamline procedures for inspections of wood products and containers consisting of wood are underway. As I mentioned before, trade facilitation is an ongoing process. It's not a single initiative, but I am convinced that it's critical for competitiveness as well as for leveraging international trade. It's my pleasure to have this opportunity to talk about trade facilitation with this group of experts participating to this seminar. I am open to hear questions and thank again for the invitation to participate here. I'd like to mention that here we have many specialists. I'm not an expert in trade facilitation. I'm just trying to put people together to work, to cooperate, and to find ways to harmonize procedures and reduce red tape. We are doing a progress. This is not a big deal. This is a permanent work. The world is changing. We have new challenges each day. The group is find ways to share database information for risk assessment, to share best practice, to harmonize work hours. The Minister of Planning is helping CAMEX to review the number of employees at each border to make it balanced with the workload. ABDI, the agency, is trying to help this group in improving rules for facilitating some type of operations such as the control of wood containers, for example, and also they all helped CAMEX approving the ATA Carnet, and by now the decision is to ratify the first annex, which is the most important one. It doesn't mean the other annex cannot be ratified later. We'll be working on that. But the most important operations will be covered. It's a long request from exporters and travelers, so we'll have more easy ways to allow goods to enter and go out of the country. So temporary admissions are contemplated. So I think from what I see here, I have to hear from you because here we have so many experts in trade facilitation. Our work is not theoretical, it's not academic, it's a daily work. It's detail, it's reviewing the form, it's reviewing the time schedule, it's reviewing the system, it's adequating the system for sharing information, it's providing better tools for many agencies to have their own risk assessment tools working. So I'm happy to have a chance to coordinate this working group. CAMEX is responsible for tough decisions. Is one each area can take. Only the most controversial cases or issues come to CAMEX. We are in charge of tariffs, trade remedies, trade negotiation decisions, but usually when we have issues that where it's necessary to build a consensus between government agents, it comes to CAMEX. One issue and one important issue is trade facilitation because it involves more than one agency, more than one ministry. So we are doing our best to move forward on this issue. Thank you very much.
Thank you. Lita Spindola has agreed to take a few questions. If you would like to make a question, please be brief so we can accommodate as many questions as possible in a very short period of time. Any questions? Over there. Would you please identify yourself before making the
Sure.
question?
Yeah, my name is Robbins Pancake. I used to work with Hewlett-Packard Brazil 15 or 20 years ago. I have a question about trade facilitation in the WTO context. My sense from your presentation is that you're working on building blocks of trade. Can't do everything at the beginning, so take small steps to begin with. There are a couple of initiatives at the WTO. One is actually a trade facilitation negotiation, which was very active during the Doha round, and which I think, in terms of the mechanics of trade, offers a lot of potential for Brazil and other countries, and I'm curious what your position is on that. And the second initiative relates to environmental goods and services. The Environmental Goods and Services Agreement was a proposal that several countries put together and has, I think, some possibilities in the current world for going forward, even without the Doha round. And I would say both of these initiatives are being discussed really outside the Doha round as well as inside, as initiatives that might go forward regardless of Doha, because it's important to keep free trade progressing forward for fear that it might fall backwards. So if you could comment on those two initiatives, that would be great. Thank you.
Thank you for a question. Very important issues. Yes, CAMEX has been participating in these WTO rounds discussion. We have some advisors participating in each meeting, and they are trying to help us as well. I think these two areas are very important, and environment, we have room for progress in this area, but the Brazilian embassy here in Washington is supporting this initiative as well as the Brazilian Foreign Affairs Group in Geneva. And they have supported CAMEX, because CAMEX is a really small council. It's an executive secretariat to support and to prepare ministerial decisions. So you are not able to be to have people permanently dedicated to WTO issues, but we keep sending people, and we have the support from the embassy and from the Foreign Affairs Ministry in Geneva for this work. Maybe Minister Carlos Henrique would like to add some comments to that. Thank you again.
Well, at least in Geneva, I would say that there is the idea that it's possible to conclude this round in 2009. We are very close to perhaps reaching an agreement on modalities for NAMA in agriculture. I think, of course, there are other important issues like trade facilitation. But I would recall that we are negotiating under the single undertaking principle, that is, nothing is agreed until everything is agreed. So I am aware that the Trade Facilitation Group has made important strides, and but we would have to wait to see how, if there are advances in the other areas of negotiation, and see if we conclude the round under the single undertaking principle. Regarding your questions on environmental goods and services, well, yes, the idea is good. Of course, the devil is in the detail. For the Brazilian government, for instance, we are not in a position to accept any agreement on that if ethanol is not included in the list of environmental goods. If we think that if we are serious about the fight against climate change, we must take seriously biofuels and we made strides in Brazil in sugarcane ethanol. At this point, our cars use in Brazil more ethanol than gasoline. And I think all new cars made in Brazil at present are flex fuel, so they can use both gasoline and ethanol. But this is our sense about this. This is a very complex issue. I would say that we are very far from an agreement on environmental goods and services. Thank you very much.
Any other questions? We have two. Let's be brief, please. Let's take these last two.
Hi, my name is Sarah Kazmarek, and I'm a graduate student at Georgetown University, and I had a question relating to ethanol. I'm wondering what steps could possibly be taken at the WTO or otherwise to address the U.S. tariff on ethanol to help Brazil increase its exports. Thank you.
Well, of course, it's in the interest of Brazil that the U.S. removes the tariff on ethanol. However, this is considered a secondary tariff. It's not exactly a tariff, and it's included in the in the shadow of in the national list of obligations of the United States and the Uruguay round. Of course, we're negotiating with the United States, trying to convince the United States to remove this tariff. But of course, and the previous administration, President Bush, was keen on this. He would like to remove this tariff. But in reality, we're a little bit in the hands of the U.S. Congress here. But we think it would make sense to remove this tariff. The ethanol industry in Brazil, it's not a threat to the U.S. industry. On the contrary, there's room here for both to complement each other. Your ethanol made in the U.S., our ethanol made in Brazil. Perhaps the Brazilian ethanol could supply cities in the coastal lines of the United States. This would be an interesting idea. But this is in the agenda, it's in the bilateral agenda. The Ministry of Foreign Affairs and the USTR have a bilateral mechanism for consultation. This issue is always raised in this context, and hopefully we'll be able to remove this tariff sooner than later, because as I said, if we're serious about the fight against climate change, we must create an international market for biofuels. And if the United States does not open its market to biofuels, we won't be able to achieve this objective.
Yeah, just one as a matter of information, this is an issue that we follow all the time here at the Institute. Just if you're interested, we can share with you some information regarding statements by U.S. congressmen, particularly Senator Richard Lugar had recently, I think it was published in one of the papers, an op-ed page on this exact issue, or proposing actually a tax on gasoline that is part of this equation. I would call your attention also, and I can share those with you, to some statements made over the last 2 years by former governor of Iowa, current Secretary of Agriculture, Tom Vilsack, on this issue. Vilsack is seen by many as a reformer of both agricultural policy and has some interesting ideas in this area. And so I think we have a dynamic. It's important to pay attention to the dynamic in the U.S. government, particularly between right now three areas of the government: the energy, Department of Energy, the Department of Agriculture, and the environmental area in the United States. That's where, in the administration, the discussion is, and from what we gather, it is a very interesting new dynamic and one that will certainly affect the debate in Congress at one point.
Paulo, you also have a special site on energy, don't you?
Sorry?
A special website on...
Yeah, we have a part of our site where we try to gather this information, but this one that I refer to you is something that I can send you, by email.
All right, one more question. Last one.
Yeah.
Hi, good morning. Bruce Thompson with Unisys Corporation. You mentioned in your opening remarks the need to reduce delays and improve risk assessment and inspection while not sacrificing increased security. And I was wondering if you could speak to the role you see of technology and modernization in that process, and specifically any specific technologies you see that Brazil would look to invest in to achieve that goal.
Thank you.
Yeah, this is very important. Good question. Technology is supporting development of database and all type of risk analysis tools. Brazil has a very interesting system, Syscomex. It's very comprehensive. It allows information, updated information, nationwide. Each day we can have statistics from the previous day. They are very trustful. I think this system in Brazil, even though it's now about 15 years old, is one of the best of the world. We keep complaining because it's not perfect, but it's really good because it encompasses information from all intervenients of the process. And why it happens this way? Because Brazil has some characteristics. Because of the inflationary process in the past, Brazil developed good IT systems for processing revenue data, controlling, and all. Otaviano Canuto can tell us better about that, but Brazil also has two important things. We have a taxpayer number, either for companies and persons. So we can accumulate all the information about that taxpayer in a single number. It's all indexed. It makes it easy to track. So if Receita Federal, which is the tax and custom administration, IRS in Brazil, Receita Federal can check what's the situation of one single company and can have there in the system the information about what were the imports and exports of this country in any combination, by product, by port, by period, by good, by anything. Can know if this company has been audited, if his company has any process in courts, if this company bought or sold real estate, if the partners or socios of this company have problems with social security, criminal problems, so it's all together. We have a huge and fantastic system where we have to improve and to work to make it better is procedures. That's our goal. That's our task. Because the system is there, we can pull out any information we need. we can have the best assessment, risk assessment system if you have good procedures and if we decide to use good criteria and to cooperate between different agents. The Brazilian tax system is very complex, as is foreign trade. It's all regulated. We have a lifelong tradition, a historical tradition of intervention, government intervention on this type of operation. Brazil opened its economy for foreign trade in 1990. 84, but okay, really 1989. So by that time, we had licensing procedures for almost all goods that enter the country. And by now, we still have some old-fashioned regulations that we are trying to eliminate. We are also reviewing licensing procedures because if we want to control everything, we cannot do a good job. We have to be more focused on risk, and you have to balance the checks and inspections with the capacity of the government agents to do a good job. So that's what we are trying to reach with this working group.
Thank you, Lita. Thank you to all panelists. Let's ask for and I'd like to invite the first panel to come over, and so we can get started. Thank you.
Good morning. Thank you for being here. We'd like to begin substantive work of the day with the first panel that will be reviewing current world financial crisis and its effects on international commercial relations. With us, we have a very distinguished panel of experts from the United States and Brazil. Speakers include Mr. William Klein from the Peterson Institute for International Economics, Otaviano Canuto, formerly Inter-American Development Bank, Gregory Harrington from Arnold & Porter, and Popeo Adreuchi Neto from the Embassy of Brazil. Aloysio will be, at the conclusion of the panel, will be offering some comments, speakers, and then we'll open the floor for questions. If the speakers don't mind, I would like to begin in the order in which they're listed. Additionally, there are bios for all our speakers available outside. If you have not picked a copy, we invite you to do so. We'd like to begin with Mr. William Klein from the Peterson Institute.
Thank you, Mr. Chairman. I'd like to thank Paulo Sutero for his kind words and Aloysio Lima Campos for the invitation to participate in this session and try to make some sense of the chaos that's going on around us. This year, the IMF predicts that global growth will be close to zero. The last time a global recession of this severity occurred was in 1982. That recession triggered the Latin American debt crisis, and the region's collapse can be seen in this chart. This time around, it is the center, not the periphery, that has collapsed. Growth in advanced industrial countries is projected at a -2% for this year. The widespread banking problems in Europe and the United States give this recession the feel of something closer to the depression of the 1930s than we've had for many decades. The global recession is marked by a tighter correlation of downswings across countries than in 1982. What you see here, the main industrial countries will have a reduction in growth rates that's almost identical for the United States, Euroland, Japan, the United Kingdom. These are IMF and blue chip forecasts. In contrast, in 1982, it was the United States that was the epicenter of the recession, and Europe, United Kingdom, actually maintained or increased growth. There's a similarly close correlation in Latin America for the downturn. This decline also is more correlated than it was in the 1982-83 crisis, even though on average that crisis was far more severe for Latin America. A reason for the less severity this time around for Latin America is that the severity of the debt problem is much less. The nations have moderated debt relative to GDP. They've built up large reserves, so the ratio of their net debt minus reserves, to GDP is on the order of 10 to 15%, now in comparison with something like 50% in the early 1980s. So it's very unlikely that Latin America will have a rerun of the 1980s debt crisis. Another reason is at this time interest rates are remarkably low in contrast to the remarkably high interest rates of the early 1980s with the Volcker shock. And of course, what matters for the debt burden is not only the amount of debt, but also how much you have to pay for it. The same pattern of highly correlated growth decline can be seen in the main Asian emerging market economies. Even China will have decline of growth from 12% in 2007 to 7% in 2009. This is similarly a contrast with the 1982 recession, in which there was much greater dispersion in Asia, but also, on average, not much of a decline at all. Now, what about trade policy and recovery? Because of the universal pattern of falling growth in this global recession, it's going to be very difficult for individual countries to export their way out of the slowdown. In the East Asian crisis of the late 1990s, it was possible for Thailand, Korea, Indonesia, and other affected economies to recover to growth through sharp export expansion and a swing from current account deficit to current account surplus. The United States and other industrial countries were sustaining growth, and that was possible at that time. This time around, it seems likely that the contribution to recovery from exports will be more modest because of the uniformly weak growth prospects of trading partners. If rising exports hold limited potential, some countries will be tempted to boost their domestic demand by raising import protection. That would be a negative-sum game. Each country acting this way in isolation would generate an overall outcome that would amount to a downward spiral of trading growth as happened in the global depression of the 1930s. For Latin America and many other emerging markets, the temptation to impose protection could be particularly seductive because of the high level of bound tariffs under their WTO obligations in comparison with the actual tariffs that they apply. In Latin America, bound tariffs tend to be in the range of 25 to 35% on manufacturers, whereas the applied tariffs are only 10 to 12%. It may also be tempting in Latin America to apply non-tariff barriers to partners in regional free trade areas. Mercosur has a history of such barriers that are erected whenever there's a macroeconomic crisis. But again, the consequence would be counterproductive. So far, there has been no widespread outbreak of international protectionism, certainly nothing resembling the 1930s depression. Yes, the United States is providing aid to autos. Yes, the United States is limiting the stimulus money to other countries that are co-members of the government procurement agreement, but that's a far cry from the Smoot-Hawley tariff of the 1930s. Moreover, today the WTO obligations will limit the increases in tariffs that could occur among those industrial countries that have the applied tariffs very close to bound ceilings, which is the case for virtually all of them. In the financial sphere, again, there's been what some could call financial protection, but also some international cooperation. The Federal Reserve has extended $30 billion each in swap lines to Brazil, Mexico, Korea, and Singapore in an action designed to help assure that the special support to U.S. banks does not have the effect of draining resources out of these countries. The trade performance, however, is sobering. In contrast to the continued rapid growth of exports in the first 3 quarters of 2008, in the fourth quarter, there were sharp declines in the exports of the leading emerging market economies. In Brazil, annual export growth fell from 30% in the first 3 quarters to 7% in the fourth. This decline is partly attributable to the decline in commodity prices, as illustrated by the case of Chile, but there's been a large deceleration of manufactured exports as well, including from Korea and China. In capital flows, the crisis has reversed the period of artificially low risk premiums into what are probably artificially high risk premiums now. Private capital flows to emerging market economies declined substantially in 2000 and are likely to fall further in 2009. These data from the Institute of International Finance indicate that the net inflows of private capital to emerging markets fell from about $900 billion, their peak in 2007, to a bit under $500 billion in 2008, will fall further to about $200 billion this year. Foreign direct investment has held up the best, but even yet is declining. Emerging market exchange rates also came under pressure in the second half of last year, as it became apparent that the emerging market economies were not, as it turned out, quote, decoupled, quote, from the problems at the center, as had initially been hoped. Even so, the depreciations have not been, shall we say, extreme, especially when compared to the euro as opposed to the dollar. The euro has also moved down against the dollar. So in broad terms, the emerging market economies so far have not been devastated by the crisis. One reason is that they have a large war chest of reserves. Reserve levels of $200 to $300 billion each for Brazil, Korea, and India are extremely high by any historical benchmarks. And the reductions in recent months to help stabilize currencies have been relatively limited. China's reserves, of course, are virtually off the charts. They have actually climbed from $1.5 trillion at the end of 2007 to $1.9 trillion at the end of 2008. What about policy action to confront the crisis? Well, U.S. policymakers have responded remarkably vigorously. The Federal Reserve has increased its loans to the financial sector by about $1.4 trillion, raising its balance sheet from $800 billion to $2.2 trillion. The Federal Reserve has also extended large guarantees, which don't show up in those numbers. The new fiscal stimulus program of about $800 billion amounts to 2.5% of GDP for each of the next 2 years. European central banks have been aggressive in supporting their banking systems, although they've not lowered the interest rates as aggressively as the Federal Reserve. China has adopted fiscal stimulus amounting to 6% of GDP for each of the next 2 years. The IMF estimates that for the G20 as a group, fiscal stimulus will amount to 1.5% of GDP in 2009, not counting an additional comparable amount from automatic stabilizers. The broad strategy needs to be for both monetary and fiscal stimulus to take place to counter global recession in all major economies, with each country's approach tailored to its situation. In Brazil, for example, where the interest rate is 14% and inflation is 6%, from the outside at least, it looks as if there might be room for monetary easing. Demand will need to grow within each country because, for one, the United States can no longer be the key locomotive for global demand. From the mid-1990s to the middle of this decade, the increase in the U.S. trade deficit with developing countries amounted to a cumulative 5% of the GDP of the developing countries. That was a nice source of gradually growing demand by the consumer of last resort, the United States. Well, that process has come to an end. The current account deficit is falling now. U.S. current account deficit was 6% of GDP in 2006, 4.5% last year. It could be as low as 2 or 3% this year, given the collapse in oil prices and the sharp decline in imports. This broadly means that not only China, but also other major emerging market economies will increasingly need to find domestic demand for continued growth rather than relying primarily on export expansion. In terms of international institutions, Japan has already offered the IMF $100 billion in increased lending capacity. To me, it remains to be seen just how much additional money the fund will need. So far, its new programs have been mainly for some of the Eastern European countries, where outsized current account deficits based on strong expectations of European integration had caused disequilibria. Ironically, for many emerging market economies, these large war chests of reserves mean that the problem tends to be not that the government is suddenly out of money, but the corporate sector is strapped for dollar-based funding, and the issue becomes how to affect the domestic firms. How the IMF gets into that interface is not immediately clear because it lends to governments. In summary, we are in the midst of the most severe and globally synchronized recession since the Great Depression of the 1930s. If we return to the central forecasts, it will be fortunate, I would say, if the IMF and private sector forecasts for return to 3% global growth in 2010 are actually achieved. If so, this recession will not have been all that much worse than the 1982 downturn. The downside risk dominates because this is the first time in the post-war period that a global recession has been provoked by a banking crisis at the center. There is also much deleveraging to be accomplished, and achieving growth while limiting or reducing debt will be a tall order. It will be crucial that all major countries pursue appropriate expansion measures and especially refrain from opposing new trade protection as the best means of helping ensure that this turns out to be a severe global recession and not a global depression. Thank you.
Thank you, Mr. Klein. We'll now proceed to Ottaviano Canuto.
Thanks. Good morning, everybody. Pleasure to be here and an honor. I will try to be complimentary to Bill. And let me focus on the impacts of the financial crisis on trade. Let me narrow down my scope and to deal as much as we can here with a possible policy response. I will certainly take profit of many of the points already made by Bill. First of all, trade is facing a collapse. And this can be clearly seen by the fall down, the sharp fall down of trade flows in the final months of last year. This is no novelty. The relevant thing to take note here is the fact that it reflects, not on the one hand, shrinking demand. So in this regard, the collapse of trade is something naturally expected from the reduction of industrial production and so on, but also it reflects, is also a manifestation of the credit crunch. That's a novelty because usually trade finance is less affected when it comes to reduction in flows and risk aversion during downturns and cycles. But as this seems to be the mother of all crises, at least since the Great Depression, the novelty has been the negative impact of the financial crisis on even simple trade credit. By trade finance, here I refer to credit and other similar operations with a time length inferior to 180 days. Let me tell you something. The firms rely heavily on bank finance trade credits. At least this is the case of emerging economies, and something in the range of 80 to 90% of international trade depends on the availability and the access of trade finance. And the fact of the matter is that as part of the whole landscape of shrinking capital flows to emerging market economies, I just reproduced the latest projections by the IIF in this table, and they led to some noise a couple of weeks ago, and not by chance, because you can note how not only in comparison with the peak year, which was 2007, but even as comparing the forecast for 2009 vis-a-vis 2008, one can note a drop of higher than 65%, more than $300 billion. As for this, of course, is a natural outcome in a period such as the one we are going through. But the problem lies with the fact that even short-term traditional trade finance flows have come to a halt. And this, as I said, comes from the fact, as Bill Klein referred to, we are not facing business cycle as usual. Naturally, after a phase of upswing, one watches normally, this is the feature of all business cycles, high risk aversion, higher standards when it comes to concession of credit and so on. But the fact of the matter is that this time we are undergoing a process that has been called the Great Unwinding. After such an intensive process of leverage of all kind of portfolios in the global economy along the last few years, we're going through a process in which the whole pyramid of assets is crumbling down, is being tentatively liquefied, and that's why one can see, that we are still, let's say, far from the end of the process of adjustment we are going through. Not only that, we watched at the core of the system an interbank liquidity drought. Because of the bank insolvency risks and the deep confidence crisis that assailed the whole banking system in all advanced economies, accompanied by this flight toward the hyper safety of treasuries. The fact of the matter is that we watched a paralysis of even the basic banking functions, not only in the United States, but also throughout the world. It couldn't be different in the case of emerging economies, and that's why we watched during the last months of 2008 a classic systemic sudden stop. The terminology had been kept to describe situations in which countries face a complete drought of capital flows and eventually capital outflows for reasons that go beyond the scope of domestic policy responsibilities. And that has been the case of most of the emerging economies last year. That's why this is called the systemic sudden stop. Reflecting, of course, the process of liquidity hoarding at the headquarters of major banks. Now, and to some extent, the inevitable national response ended up aggravating the problem because they naturally recreated the so-called home bias in financial flows. During the upbeat period of globalization of finance in the last few years, many pundits had come to the point of announcing the end of home bias in financial flows. Unfortunately, in the context of the crisis that we're going through, the home bias comes up again, tending to reduce, let's say, most of the impetus of globalization at large that we have been seeing in the last few years. Now, in the case of developing countries, in the case in general, in particularly emerging markets, as Bill has showed, many countries have been able to build at some war chests of reserves, at least from the public sector standpoint, at least from the global, the balance of payments standpoint, although at the corporate side, one cannot affirm that no vulnerability has been, let's say, developed in the last few years. But at least in the case of those countries that had been, let's say, more hesitant to delve into the process of indebtedness, public indebtedness in the last few years, a situation of net reserves has been acquired, and this has, let's say, provided these countries with a type of war chest, and these war chests have been used tentatively in order to countervail the tendency of complete drought in the export finance. In the case of Brazil, just to name a few of the measures, on top of being a participant of the Fed swap network, although so far the swap network has not had to be used, but it is important to be there because it is a deterrent of let's say, risk downgrade from the standpoint of creditors. But as far as the other traditional instruments of intervention in the exchange market, certainly Brazil has, as some of you might be aware, resorted to spot sales of dollars in the spot market. Just to give an idea, the latest amount that I have here, Brazil has, since the beginning of the crisis, sold $14.5 billion, corresponding to 7% of the international reserves at the spot markets, but also acting through the sophisticated derivative markets in Brazil to also sell dollars. On top of that, which matters more for us here, the Brazilian government, the central bank, has provided on a repo basis dollar both in the spot market, attaching in some cases these repo operations with the provision of liquidity to Brazilian companies, but also the special repo trying to fill in the void left by the liquidity drought with repo operations with banks in order to make sure that there would be the advance on foreign exchange contracts, ACC as we call them in Brazil. Now, the reason why I put these figures, these tables at the side is the following. I got that yesterday from Credit Suisse, showing how the first part of February has witnessed a revival of trade credit in the case of Brazil, as can be seen in the increase of the business day flows associated with the trade. And this has been associated with the fact that advances on foreign exchange contracts, the ACC, have been put in place with the use of the Brazilian reserves. And this reflects itself in the average daily level of operations. Of course, they have not come back to the levels of the previous years, naturally because the size of the exports will shrink, but also because there is still a seizure at the external side when it comes to credit provided by banks outside any emerging markets. So we are really in deep trouble in that regard. Now, the important thing to remark here is the following. Of course, these war chests developed by emerging markets, particularly in the case of countries as the ones referred to by Bill, have been, let's say, quite useful and quite providential at this moment. But let's keep in mind that if this crisis prolongs itself, the war chest itself will cease to be enough. It will cease to be, well, the little by little or in big chunks, depending on how things evolve, these war chests will disappear. So we have to be ready for the possibility that this crisis goes beyond 2009 and enter through 2010. Now, of course, I don't have to highlight here all the many adverse effects of trade credit crunches on developing countries, particularly given the export-led nature of the growth of many developing countries, as highlighted by Bill. But also there is a subtle effect on globalization that should be taken into account. Everyone knows how the increase of trade in the last few years has been associated with the building of complex networks of production process. This is, the basis of, as we all know, the world taken as a flat one. Now, of course, this full shrinkage of trade because of trade finance is leading to a high risk of disruption of many of these production chains. And on top of that natural tendency of this shrinkage in the role played by these global networks, one has to take into account also the so-called to be transferred to the private sector. Of course, we also have heard of bilateral and regional arrangements. Brazil has talked a lot about extending facilities to the neighbors and so on. It's understandable. We have heard a lot about the Asian countries establishing, going ahead with the Chiang Mai initiative and so on. The risk is that one might, instead of having the global economy receiving through this financial arrangements, a push to a breakdown into regional arrangements, which of course doesn't bode well for a global economy. Finally, one thing. Everyone is talking about Smoot-Hawley, isn't that so? And the risk of trade walls again. Let me tell you the following. A text written by one of my colleagues at IDB, Anthony Stereo-Doval, together with Alan Winters, and in 2002, made the first systematic empirical exam of determinants of trade collapse in the 30s. And although they recognized, they captured the effects of the trade war, but they also highlight the relevance that the breakdown of the gold standard then had on the trade collapse. The reason why I'm recalling this is because the financial aspects that I referred to during my presentation, they might bear dire consequences, at least as dire as the ones associated with the trade walls. So let's not only look at tariffs, let's also look to this crumbling of the financial arrangements, because they might lead to trade downfalls, maybe even tougher than the one that one might expect, just looking at tariffs. Thank you very much.
Thank you, Otaviano. Before we move on to our next presentation, I just wanted to acknowledge the presence with us of the Mexico Institute public policy scholar Lázaro Cárdenas here with us. He's former governor of the state of Michoacán. He's been working with us for quite a while. He'll be here until the end of the season. Welcome. We now proceed with Pompeo Anderucci Neto's presentation.
Okay, thank you, Jose. Thank you, Aloysio, also for organizing this symposium. It's very hard to speak after such brilliant presentations from my two colleagues, Bill and Otaviano, but I will just try to give you an idea of what is going on in Brazil briefly, how the current crisis is impacting the country, what the government has been doing, and how we are looking for the future landscape. Inevitably, Brazil has been feeling the crisis impact. We learned very fast that decoupling was just a nice word, and the communication channels like foreign trade, exchange rate, and levels of investment were very clear, indicating that Brazil would have to come up with a strategy to face the effects of the downturn in the central economies or more advanced economies. On one side, Brazil has never been so well prepared to face a crisis. As my colleagues point out, we have foreign reserves at the level of $200 billion. Fiscal budget is balanced. Unemployment rate is increasing, but is still manageable. Foreign trade is doing well and is not so dependent on commodities anymore. And the levels of private investment for capital formation is good. At the same time, we have had record levels of foreign direct investment in the last years, and the stock exchange is doing well, relatively well, considering the environment. The government in Brazil is very aware of the crisis, and many actions have been taken in the last months. On one side, we are very focused on maintaining the level of investment in infrastructure works. Just yesterday, we learned that the Brazilian government released 4.2 billion reais, that's around $1.8 billion, for financing infrastructure in the country. We are very focused also in attracting foreign investment. As Minister Carlos Henrique mentioned at the opening of the session, President Lula will be in New York on March the 16th on a panel organized by the Wall Street Journal to talk with foreign investors and also to talk with decision makers and about the image of Brazil, and then he will come to Washington. So, I mean, besides infrastructure, foreign investment, we are also concerned about the level of employment. The government is keeping its investment in the social safety net. That's very important in Brazil. In the last 6 years, at least 17 million people were raised above the poverty line. That was like one of the greatest achievements of this government. And the private sector has been doing relatively well with mixed results considering the crisis. Yesterday, CBRD, for those who are holders of shares of CBRD, posted a growth of 6.3% in the last year. A few people complained, saying that was very low, considering that the CBRD grew by 42% from 2007 to 2008. But it's still, I mean, considering the crisis, those are good news. As you know, eventually this crisis will pass, as happened in the past, and Brazil is preparing and focusing for the future. We want to be prepared and well-positioned for the next growth wave, and for that we are not only preparing the country, but also expecting and holding very high expectations for global coordination on the efforts to face the crisis. In that sense, Brazil is working very much to help to prepare the next G20 meeting in London that will happen on April the 2nd. And essentially, what Brazil, the Brazilian government, is expecting from that meeting is not only a follow-up from the Washington meeting, where Brazil played an important role as the chair for the G20, but also we are expecting a very strong political message from the leaders of the world to say that anything that is necessary will be done to cope with the crisis. On one sense, that meaning that protectionism practices should be completely avoided. As Bill Klein mentioned, Brazil is very concerned about that. We do have bound tariffs high or higher, consolidated in WTO, but we are also hoping that our trade partners, like the U.S., for example, would avoid protectionist practice like Buy American Act and some other practices that have been proposed lately. We are expecting more coordination among main economies. That meaning that developed economies should be coordinating positions with emerging markets and less developed countries. We are expecting also the definition of a common platform for international regulation of financial institutions. And also we are looking forward for a more proactive role for international or multilateral financial institutions like the World Bank, IMF. Brazil is very active also, very actively working towards the to get a large and bigger capital for IDB, for example. And we expect that international bodies like the Financial Stability Forum, the FSF, may be a good element in trying to stabilize financial markets. Brazilians are always hopeful. We do expect that the future will be much better than the present, and we are working very seriously on that. Brazil is doing a great effort in the region, in Mercosur, and also in South America. That's it. Thank you.
Thank you, Pompeo. We'll proceed to our final presentation of the panel by Gregory Harrington, Arnold and Porter.
Take a second to come up, please. Thank you. Good morning. I have to apologize for my voice. It may not be as crystal clear as I would like it to be. I wanted to thank Aloysio for the opportunity, and Pompeo mentioned how difficult it is to come after Bill and Ottaviano, and you can imagine now my position, so it's only gotten worse, and that without a voice. I wanted to focus a bit more on maybe on a 10,000-foot level of what is happening with Brazilian corporates, Brazilian companies, and what are they facing in this crisis, which maybe they didn't face in the last financial disruption, not the one of '82 or not even the one of the early '90s, but the one of 2001, 2002. When we went through things such as 9/11, Enron, the drought crisis for some corporates in Brazil, and then some of the uncertainties around the elections of the time. At that time, the way Brazilian corporates dealt with closing capital markets and the ability to finance both their operations and then their trade operations was to take loans of shorter tenors. Now, trade finance typically always has shorter tenors, as Ottaviano mentioned, but in terms of pre-export finance, where they were taking resources to build out and then export, which has much longer tenors, they were also finding those either very difficult to receive in terms of financing as lines were being cut, or for much shorter periods. One of the responses that they took was pure secured transactions, such as securitizations. Many of the banks securitized their capital inflows, their MT100 flows, that are derived partly from trade, also from remittances, or other securitizations of assets, the non-banks, in terms of receivables and other securitizable assets. securitizations today have a much different feel for them than they did at the time. Insured bonds also at that time was another way of financing operations and financing build-out, in that getting insurance on top of either political risk insurance or other insurance from the employers such as AIG. And then also in terms of liability management, what was done in terms of companies that had liabilities, debt which was maturing around that time, undertook things such as exchange offers and waiver solicitations and consent solicitations to change the tenders, or to change either the interest rate or the maturities. And I'll discuss that a bit more. From then on, 2003, 2004, the markets began reopening, and then 2004 to mid-2007, it was a very much of an open market environment. You saw the rise of novel products such as perpetual bonds, which are something that would be extremely difficult to try and market in this environment. Subordinated notes, also hybrid capital. On the local market, instruments such as FIGICs and FIPs, also many ways attracting cash from, while they're local market instruments, attracting cash internationally from hedge funds, which were active opening accounts through Brazilian intermediaries. You also saw at that time a surge in equity issues, which companies would then take those resources and finance their operations, including, in many cases, their trade operations. Well, since mid-2007 and the onset of the subprime crisis, you saw a period from mid-2007 to September of 2008 where trade finance really did surge. Trade finance, in many ways, as I think Otaviano mentioned, comes to shine at a time when markets otherwise are closed for debt capturing, because trade finance, in many ways, in many times, is secured financing, either short-term through quasi-security guarantees, letters of credit, and standbys and the like, or also otherwise truly secured in terms of using the receivables from the trade to finance your operations. And also during that period, mid-2007 to September 2008, you did see the continuation of project finance transactions, again, things that did not depend on capital markets, but more on bilateral relations or multilateral. The current environment, I think the key thing here compared to other times is, as everybody else has mentioned, it was quite obvious, this is coming from the center. It's turned into a global crisis, and it's certainly not a Brazilian crisis. Or let's say Brazil is in no way, I think the term is not, it's not Brazil's fault this time. Its fault is much, let's say, closer to home. But at the time, what is available to Brazilian corporates with the recoupling, if you will, what options are available to them? Well, again, a few years ago, liability management transactions was one way that a Brazilian corporate could finance or refinance its maturities. Well, in the current market, while there have been some successful exchange offers and solicitations and other liability management transactions, pt1 is, I think, the most recent. The markets, even for exchange offers, the ability to exchange your current debt for a longer period of debt, you're finding that either you have to pay exorbitant amounts or the market just simply is not there. People looking for liquidity want you to pay and want you to pay today so that they can redeploy those assets elsewhere. You also find some limited secured financing and some still local market financing available. But what you find are the private banks are, if they're not hoarding their liquidity, they're certainly reserving it for their top clients, for their top relationships. I remember when I was a very junior banker in the late 80s, early 90s, before I went to the dark side and became a lawyer. My first task as a lending officer at Chemical Bank was to call a number of banks throughout the Caribbean to cut off all of their trade lines. Now, it was sort of a rough way to get introduced to international finance, but it's certainly something that happens, in that trade finance is something, and these finance lines are the first things in many ways to get cut. And when you do have lines, it's reserved for your primary and your primary relationships and your AAAs and your A's and B's and C's. And even that, when it's available at much higher spreads, where maybe LIBOR +1, LIBOR +2 a few years ago, or even 12 months ago, you're now finding LIBOR +4 when it's available. And even local market financing, while Brazil has done a tremendous job in terms of strengthening its local markets, even local market financing is much harder to get in Brazil, again, because much of the money, though certainly not all of it, much of the money was coming from abroad. And then trade finance, as you're receiving it now, you're finding it weakest in syndicated lending because syndicates are finding it much harder to form. You don't know who might come in, who may not come in. And then also, as I mentioned earlier, pre-export financing because they are longer tenors. You do still find some trade finance operations that are going through, but many of them are just dressed up secured financings, which are secured financings which would have been naked bond issues 12 months or 18 months ago are now dressed up as trade finance operations, partly to take the benefit of some favorable tax treatment in Brazil, but also because it is secured financing. So you find trade finance operations going now for A and B credits, where in the past it just would have been naked lending. If there is a silver lining in this, and I think as others mentioned, Brazil does have an extremely strong banking sector. It's very well regulated and very well capitalized, where the U.S. Basel standards are 8%. In Brazil, they are 11%. But even at 11%, you'll find a Brazilian bank is typically much higher capitalized, 16, 17, 18%, if not beyond. Brazil, as others have mentioned, has historic levels of international reserves, which again, quite a bit of foresight on the part of Brazil. A lot of rainy day funds where I think some of the folks in California or in other states, United States, New York, should have been taking notes much earlier than they were. You also find early and coordinated government action in Brazil by all parts. I think the most obvious example is the Brazilian Central Bank. In terms of loosening up some of those reserve requirements, which kept Brazilian banks so strong. It's another tool to open up financing, and then also the use of the international reserves, as others have mentioned, and how it's been affected. And then, of course, support by official institutions, whether multilateral or domestic government institutions. So again, the past approaches and solutions which have worked historically are just not available today. Securitizations, I read an article the other day that when USA Today is mentioning securitizations, it's become a really bad word in finance. It's one thing for the Wall Street Journal, but when it gets USA Today, we've got problems. So securitizations and even high-quality assets, securitizations are difficult to sell. Now, the problem, of course, with most securitizations in recent years is they're just very nebulous and difficult, hardly quantifiable instruments. But even quite clear instruments with strong flows are having a very difficult time heading to market. Insured bonds, I think the insurance companies have suffered through this crisis as much as anybody. And also insured bonds, it's not political risk or other risk that might be insured here. It's global uncertainty, and how do you assure against that? Liability management transactions I've mentioned are much more difficult, and trade finance, which has always again shined during crises, is also finding it difficult as trade spirals down. What do you finance, and what assets do you finance against? New solutions are being tested. I think others have discussed them much more eloquently than I can, including the trade facilitation programs, more government spending, and then also direct lending, where you have direct lending from the export credit agencies where they may have used intermediates. If the intermediates don't want to intermediate, you find many of the ECAs doing direct lending, which is not something that they would have done in the past. And then I also mentioned the Brazilian government's coordinated response. And then finally, just some old solutions are coming back. Factoring and forfeiting, something that would have been almost embarrassing for a company to do a couple of years ago, are coming back as they're just discounting and selling off the receivables. And you are finding less open account trade, much less trust me, and much more collateralizing of the full process chain. And again, not just the end receivable, but collateralization also of the means, the pre-export, the production, the transformation, and then the ultimate receivable. So I think that's all that I wanted to mention. Thank you.
Thank you, Gregory. We now have brief discussion comments from Aloysio. Please.
Well, if it was tough for Greg, well, I will try to point out some of the conclusions we can come out today from all the presentations, and maybe add a few comments at the end. I think one conclusion is that Brazil is much better prepared this time to face this crisis than in any other previous crisis. And again, it was not generated in Brazil, as Greg pointed out. It's much closer to home. So that's good news. And there are several reasons for that. The Brazilian banking system was not as exposed to the real estate bond issues or the bonds there that created the whole problem. And that was one thing that did not affect the Brazilian system. The second one was, of course, the level of reserves in Brazil was record high, something that was absolutely new for the economic situation in Brazil. I think the other conclusion we can make of our presentation is that the recession generated by the financial crisis is very tempting for protectionist actions. And Bill, for example, mentioned the fact that with all the water, meaning the difference between applied tariff and bounded tariff, that exists, that would be very tempting for countries to increase their tariffs. But the good news is that this is not happening, not in Brazil and not in many countries where we could expect that. And I think the other consequent conclusion we can take from this is that I guess all countries have learned from the 1930s and from the Smoot-Halley situation, and we know what it can lead to. And we also learned that probably the best remedy for all this is countercyclical policies. And if we look around the world, what the governments are doing in greater or minor degrees, but they're all doing countercyclical policies. We're seeing the stimulus package here in the U.S. We're seeing the stimulus packages in Europe, in China. And I heard yesterday from a very high source that China is spending a lot more than the United States in stimulus. So it's good to hear this, that we're not going in the same direction as in the 30s. So that's also good news. Not so good news is the fact that sometimes the stimulus packages can exaggerate a little bit, and sometimes it may hurt some of the clauses of the agreements in multilateral agreements on trade that have been signed at WTO. But it's something we all need to watch for, because we don't want that from one side having the countercyclical policies helping the economy, on the other side hurting trade. I think another conclusion is one that Otaviano Canuto mentioned, and is the question of we need to pay attention also to the impacts on the finance side. As Greg mentioned, the first things to be hurt when there's a liquidity crisis are probably lines of credit for trade. And I just returned from Brazil, and I was surprised to know that today in Brazil, over 90% of the loans being made on credit for trade operations are directly coming from funding from the Brazilian Central Bank, because the banks are not doing it. So it's a concern, and it just goes to show what Greg just said, that the trade side is the first one to hurt when there's a liquidity crisis. So so we have good news in the overall bad environment, let's put it that way. I think this is probably the best opportunity we have to do something, not only about what went wrong to create this crisis, but also learn from this and do the changes that are needed so we can avoid this crisis in the future. And I would like to just very quickly mention a few things that have been discussed in several conferences and symposiums that are happening. They're discussing this issue. The one thing, since we're talking, the name of the panel is Trade and Finance, I would like to concentrate on the part that has to do with more with trade. And one of the things that one of the ideas I have been supporting for the past few months have been put forward by Barry Eichengreen from University of Berkeley, California. You can go into his site and read his article. And he's one of the ones that proposes the creation of the World Financial Organization. It doesn't mean that the IMF needs to disappear, but I think the IMF needs to be rethought. Maybe a deep restructuring to bring the IMF to the new times. It was a great institution when it was created in the Bretton Woods meetings, but times have passed. Today we live in a new world, and that needs to be faced. And the most important thing is that we learn that trade and finance are inseparable. They depend on each other. And there has not been a coordination of multilateral institutions in this area. The WTO has been pretty much alone, and even when Brazil started noticing the restrictions on trade credit, Brazil went to the WTO and raised the issue there instead of going to a multilateral financial institution to raise it, simply because there wasn't one there to do that. So it's important to have something of like a World Financial Organization, which would have a similar structure as the WTO, as Barry Eichengreen proposed. And I would add to that also a question that I think is very important is the question of the credit rating agencies, that nobody knows what the criteria is for giving those credits out. We know what was done during at the beginning of the crisis with the real estate securities. And just to make an example here, I don't want to pick in the old city of London, but since the data came to me, I'm going to use it. I don't know if you know this, but in terms of trade surplus, indebtedness as a proportion of GDP, and size of its foreign exchange reserves, Brazil does a lot better than the UK. And if you look at the ratings of one and the other, it doesn't make much sense. and you go and ask for a credit rating agency, well, what's the basis for this difference in rating? And the answer you get is, well, that's confidential. There's a problem there. And then you don't know clearly how much of those private credit agencies, or how many of them, are providing ratings to the same people who are paying them, because these services are paid for. So I feel that it will be a lot better for the system to have an international multilateral organization do these ratings, and with transparency, with everybody knowing what the criteria is, how it works, and so on and so forth. So I don't want to extend myself too much, but I'll leave these final comments with you, and we can open for questions.
Thank you, Luisio. Please, if you can identify yourselves, we'll take a group of questions first. There are a couple of microphones making their way around. Please, sir.
Hugh Schwartz, presently with the University of the Republic in Uruguay, formerly with the Inter-American Development Bank as an economist. So this, the comment question is oriented primarily towards the economists on the panel. But all of the presentations have acknowledged implicitly the importance in this crisis of psychological and other behavioral factors. And the truth of the matter is that the economics profession is only recently beginning to take psychological and behavioral factors into serious account at the micro side, and now beginning at the macro side. And you have a book which has just come out this week by behavioral macroeconomist Akerlof of Berkeley, and a distinguished financial economist Schiller of Yale, Animal Spirits, which touches on the role that psychological and other behavioral factors play, and in my recent book, A Guide to Behavioral Economics, some other factors. Now, the point is this. The point of both of these books is that you cannot deal with these kinds of factors. You cannot deal with phenomena in which psychological and other behavioral factors are playing an important role, and an increased role recently, without explicitly taking them into account. And with all due apologies, you're acknowledging, all of you, that implicitly that all of these factors have had a consequence, and yet there is no explicit way of dealing with these, and we are only roughly emerging with how to handle this, but we need to make some effort to incorporate this factor, these factors into the analysis if we are to determine how big stimulus packages should be, what should the composition be, and so on. Thank you.
Thank you. I have a question here in the front, please.
Yes, good morning, and it's a coincidence, but I'm coming from Uruguay also. My name is Hugo Cairuz, Embassy of Uruguay in Washington, D.C. I have a question to, I think, Mr. Canuto. Coming from the IDB, I would like to ask you if you could elaborate a little bit more on how this crisis could affect Latin American countries. I think that I would very much appreciate if you can make more comments about it. Thank you.
Any other questions at this point? Please.
Okay, can I start?
Yes, if we could take them in the panel order.
Thank you. First on psychological and behavioral aspects. You are perfectly right, but I wouldn't circumscribe the newly accepted discoveries of failure just to behavioral economics, black swan phenomena. The efficient market hypothesis it's gone, as the spring, what we used to call anomalies of financial markets have become more normal than otherwise. The question is, unless you give me the recipe, everyone has acknowledged, or most of the economists have acknowledged, that these anomalies had been underestimated. But the fact of the matter is that no one knows exactly how to deal with them. The only derivative of this perception is that I can pinpoint is the following. Under the current circumstance, we'd better have governments erring from exaggerating the response, the fiscal side, rather than making the mistake of giving less, which is basically what most of the speeches given in the case of the U.S. and in England, not Germany, have spelled out quite clearly. The fact of the matter is that we don't know exactly what to do with this perception that the financial markets can produce results really unexpected by a couple of years ago. One point, we are talking about financial crisis and so on, but this crisis goes much beyond financial issues. Of course, the financial follies were part of this whole process, but let's try and keep in mind that we have more at stake. Otherwise, one starts thinking in terms of the crisis. Well, there is some follies done by those crazy guys. Greed prevailed, and the guys made some adventures in finance. Because the outcome of this diagnosis is that when you fix the finance, you are okay. No, there are deeper things here at stake. The financial follies in the U.S. have to do with the strange or the unstable balance that marked the growth of the global economy in the last 10 years. That includes the generalized export-led growth by Asian countries and so on. So this is not simply a financial crisis. This is a real side, important aspect. On Latin America, very briefly, the channels of transmission of the crisis are the same: trade, remittance, and financial. But the weights vary substantially in all cases. Take Central America. Basically, Central America is more dependent. Depends more on remittance from the U.S., and they are net importers of food and oil. So, on the one hand, this latest stage of the crisis, one in which the commodity price have slumped, these Central American countries have benefited from this. But on the other hand, they have fragile banking systems, and they're going through. They have been the major victims of this process of sucking finance from developing countries toward back the core economies. South America is more dependent on commodity exports, but again, one has a heterogeneity of conditions. In different degrees, the public finance in these countries depend on the price of commodities. I can say, there's no problem, there's no secret that one should be most concerned with the fates of countries like Ecuador, Argentina, Venezuela, and Bolivia, but particularly to different extents, Argentina, Ecuador, Venezuela, because of the dependence on fiscal revenues on the price of commodities and the taxation on them. But generally speaking, no one has escaped from the crisis. Now, there is a difference, of course, derived from the fact that the war chests in these countries have varied substantially. Chile is the country that is best equipped at this moment, but on the other hand, is feeling the pain of the commodity price slump. Everyone is, in the case of Mexico, obviously, the dependence on the U.S. economy, as a specific. If we want to have a good thermometer for southern cone of Brazil, look at China as well. There is a high correlation between news of growth in China and the stock exchange in Brazil. It's incredible, not by chance.
Well, that's encouraging.
Depending on what happens in China, anyway.
Please. Yeah, and on the psychology, I have been astounded the way that first Secretary Paulson and then President Obama and now Fed Chairman Bernanke have completely departed from the traditional official position, which is always that things are going to be okay and trying to calm markets, and have made these. When Paulson said, if we don't have this $700 billion, the end of the world as we know it will occur. Well, Congress hesitated, and the stock market fell, 10%, 9% in space of, a day or two. President Obama, on getting his stimulus plan, basically did the same thing. In order to get the stimulus plan, if we don't do it, all hell's going to break loose. Well, and made the statement that this is going to be an absolute lost year, a terrible year. Well, the stock market went down fairly briskly, despite the progress on the stimulus. Now, Bernanke seems to be the most pessimistic of all. Not only that, he's telling everybody he's the most pessimistic of all. Somehow you wouldn't have anticipated that Greenspan would have been doing the same thing. So what I wonder is whether there's some brilliant new psychological economics insight that maybe Larry Summers has got his fingers in all this. And what you really want to do is really tell people how terrible it'll be, because then they'll be pleasantly surprised. I don't know.
With very little.
This has been quite a surprise for me. Secondly, I want to come back to something that Mr. Canuto said, which is that what about IFIs lending to the private sector? And as I look at the bank numbers that the IIF has got, they've got bank flows going from $400 billion to a minus $50 billion from 2007 to 2009. Well, it's a little bit hard to have that kind of a collapse, and the bonds are basically zero, without tightening up on the trade credit. So, query, after all, it was sort of a breakthrough when the EBRD started lending to the private sector. Gee, that's and you can see from the historical context why that was done. But maybe it might be worth at least contemplating some facility of the fund where basically there is support for trade credit to the private sector that somehow has a guarantee of the governments or whatever. Some sort of mechanism like that that might take account of this. The only other comment would be that maybe some of this short-term credit freeze will start to thaw with the Fed now getting into a very aggressive backstopping of securitized short-term stuff. That's sort of a next step following many of the other massive backstoppings that it's done.
I just had one very quick thing to say in response to Hugo's question. Actually, I'm not necessarily part of the panel, but it's a point I can't help to make because my vocation as a political economist, and it's a point that perhaps will resonate with also one of our public policy scholars here, Mr. Leslie Bethel, who's a noted scholar of Brazil and Latin American history, is that points have been raised regarding the Great Depression and the recession of 1982 and their effects in Latin America. One should note that in both of those occasions were big systemic crises that had tremendous political repercussions in Latin America. In the 1930s, many democratic governments in the region fell, starting with Argentina in the coup in 1930, and then throughout the rest of the region. And again, in 1982, we see a return to democracy in the context of that crisis and a major restructuring of the economy. And as a political economist, one wonders about the political repercussions of a crisis that is called as a systemic crisis, the deepest one we've seen so far, and whether this will have any political repercussions in the region. I think that As the panelists point out, in terms of the strength, the war chest with which Latin American countries come, and again, here generalizing quite a bit in terms of not only Brazil and the commodity-producing countries, but also some of the consumers like Central America or the Caribbean, I am a little bit more optimistic about the possibility of the crisis not having the type of systemic political repercussions that it had in previous occasions, although I'd certainly remain attendant and observant of these political circumstances. Any other questions at this point? Yes, please.
Thank you. Jeff Hornbeck from the Congressional Research Service. Bill Klein did a really great job of giving us a very succinct understanding of the synchronized nature of the global downturn, which we're all aware of, but it pulled it together very nicely. And the limitations on the United States in being the consumer of last resort, no longer looking to us to be able to pull the world out of recession, and hence the implied response being a synchronized recovery of some type, pointing to China and its potential for domestic demand being one aspect. I was curious if you would comment a little broader for me on what role the rest of the developing or emerging economies might play in this synchronized recovery, not just in the middle-income countries, but also the low-income countries or the least developed countries, and what might be the implications for U.S. policy in encouraging that kind of recovery, a synchronized recovery of that sort, and particularly for trade policy, going beyond what we've all noticed so far, which is that protectionism is not the good way to go. If there was something a little more specific.
Well, I think the emerging market economies do have a role to play in bringing the world economy out of recession, and I think China is a prime example of very large fiscal stimulus in the form of infrastructure. I think, in a sense, what the U.S. can do to try to encourage that is to be as active a player as possible in the G20 and other international efforts at coordination, where there can be sort of at least a collaborative effort to make sure that each country is doing what it can, what it has space to do, to revive its economy and in a non-protectionist way. That, as I said, it's going to mean fiscal expansion in some countries, monetary ease in other countries. In some countries, it will not be possible to do anything. As for the least developed countries and the low-income countries, they are not going to be the factor that drive a global recovery because they constitute such a very small fraction of the world economy. For them, it's mainly a question of ensuring that somehow there isn't a negative impact on them, and probably commodity prices are where that affects many of the most, and there you have the IMF's compensatory finance facility kind of commodity facility that can play some role. But I think you're right that somehow fleshing out what each country can contribute to global recovery is a task.
Can I say something on this? So, please. Just adding something to what Bill said on this regard. We should keep in mind that the fiscal package that are being implemented, they are to be a bridge to a new growth path. Okay, they're not a solution to the crisis. They are part of the counter-cyclical response, but not naturally. They will spark a new growth path. And as being aptly said, this period, the U.S. consumer-led expansion is gone because it was unsustainable, or at least it was sustainable only to the extent that it was possible to build this whole financial pyramid that provided wealth gains and so on. But this is gone. Now, the only imaginable new frontiers, besides the obvious ones such as investments in clean energy or in modern infrastructure and so on, they are to be in consumption and of the emerging markets. The new middle classes in emerging markets are the only, the only possible obvious way forward to generate the excess demand so as to have the economy, the global economy, getting back to higher. Otherwise, we're gonna be through a 10-year process, not deepening the crisis, but not really getting back to the high growth period of the last few years.
Right. If there are no further questions, I'd like to ask you to join me in thanking our panel for excellent presentations. We'll be taking a very quick break, 10 minutes.